All right, good morning, everyone. It is, let's see, 6:43 on the morning of March 8th, 2023, and this is my pre-market strategy session. So there's a little bit. I've been missing some mornings. I've had a couple of things that have pulled me away in the morning, and on top of that, I've got a couple of sick children, and comes with a fever. So it's been a little bit hectic for me here. Uh, haven't been able to get the daily pre-markets out like I usually can, but this eventually will pass, and everybody will be healthy in the house, and I'll be able to get these dailies out again. Okay, so title of the video is the 10-2 spread deep in record territory. Now, yesterday, let me go back to a daily here, and here's yesterday's close. So, as of yesterday's close, you could get 103, or I should say 1,039 basis points more in the 10-year or in the 2-year yield than in the 10-year yield. And so here's what happened yesterday. So here's the 2-year yield yesterday, and it's on a tear here in the past month. Roughly, the 2-year is rocketing up, which means there aren't a lot of people buying, and so or I'm sorry, there aren't a lot of people buying, and so the price of the yield is going down, which has an effective increase in the yield rate. So if I can buy $100 coupon, or $100 2-year note, and I can buy it for say $95 instead of $100, then I'm getting that extra yield on top of the extra value on top of the yield that it produces, and so that calculates into a higher yield. So right now, the yield on the 2-year is at 5.041%. And the 10-year has pretty much remained flat here. It did have a run up, but hasn't. It's starting to pull back, unlike the 2-year. And so that 10-year, 2-year spread is dropping into record territory. Now, if we go back, and we go back to the monthly chart here, if we go back, you can see that the yield curve can be inverted, and the bond market always gets it right. So here's this yield curve inversion occurred before the dot-com bubble burst, and this yield curve inversion occurred before the housing bubble burst. And the markets were bullish in the time frame in the time frame that the yield curve was inverted. The equity markets continued to march higher, and my guess is that's what's going to happen this time also. It's when the yield curve normalizes that you start to see the top. Now, the blue lines mark the crash dates, or the real sort of big moves down. But about 2 months prior to the yield curve normalizing again is when the top came in the equity markets. So we're going into, I think it's month number 9 here. Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9. Yeah, we're in month number 9 of this yield curve inversion that historically speaking has lasted anywhere between 12 and 18 months. And I expect things to remain bullish on the equity markets until this yield curve begins to normalize again. So about 2 months prior to the yield curve coming back up and crossing over the zero line here, and then taking off, that's when we'll see the next top. And so wherever that is, we are still well within correction territory, I believe here. Actually, we might still be in bear territory. Let me go to the highest close here. So it looks like the highest close is roughly, I'm going to say it's here. This is where we got the highest close, which is on the December 27th, 2021. I'm going to take that over to the previous close and see what kind of percentage we have there. So let's see. Let me put it on the monthly chart. That'll be easier. So find December. That's January. That's December. Okay, so there to there. Yeah, the Qs are still down 26.37%. So my guess is that while this yield curve inverts and everybody's paying attention to this, my guess is we're going to get somewhat of a sucker's rally, and then wherever the price is when this yield curve starts to normalize again, we see the next leg down. The trick is going to be that everyone is looking at this. Everyone that's in the financial industry, that's a portfolio manager, a trader, hedge funds, so on and so forth, everybody has their eyes on this. The trick is going to be, can Wall Street pull some kind of rabbit out of the hat so that the next time the yield curve starts to normalize again, the equity markets don't crash. That would be quite a feat. But so for the time being, though, it's bullish. This yield curve can continue to drop down into record territory and stay down here. It's about 2 months prior to the yield curve normalizing again that we'll see the next crash. So I'm bullish until then. All right, everybody. Good luck. Keep your risk tight. Click like, share, subscribe. Thanks for tuning in. I'll see you at tomorrow morning's strategy session. I am out.